Gentlemen, welcome back. You're back with MGTOW Money. Today's topic is going to be lessons from losing $2 billion US. Before we get to that though, I want to thank all the Patreon supporters of this channel. I do sincerely appreciate their support, as well as I appreciate all those guys that bought me a cup of coffee via PayPal. You can see those links in the description of this video. I do sincerely appreciate it because we are moving this channel forward. Let's get on to today's topic, lessons from losing $2 billion US. Let me define what I'm talking about here, gentlemen. A private equity firm is very similar to a hedge fund. It is a privately run fund, if you will. It's not publicly available, and they are geared towards people who are extremely wealthy, or if you run a pension fund or some sort of foundation, maybe a charitable foundation or something like that, these funds are run by extremely smart people. The people that you see on television and the financial news quoted in magazines, etc. The guys who have the Harvard and Wharton MBAs, the smartest guys in the room, as they say. That's the type of guys that run these private equity firms. Interestingly enough, there was an article about 6 weeks ago that I've been meaning to talk about, and I think now it's most appropriate because they give these amazing stories, these private equity firms, about consistent returns, safe returns, just wonderful PowerPoints, I can assure you. And I'm going to include a link in the description of this video to the article that I'm talking about. Specifically, the private equity firm that I'm talking about is one called Intervest. Intervest was a private equity firm that raised approximately $2 billion US to invest in oil and gas wells. Now, I'd say that's a pretty good chunk of change, wouldn't you? $2 billion. There was only a couple of problems though. One, the money is all gone. And it's not gone through the typical Bernie Madoff Ponzi scheme, that type of thing. How did they lose today? And I'm quoting from the article, the fund now is virtually worth nothing. So how did they go from attracting $2 billion from very wealthy people to basically zero? That's what we're going to look at today. Number one, they over-concentrated their monies, that $2 billion. They put far too much of it into one particular asset class. In other words, they put a lot of money into oil and gas 2014, 2015, 2016. Gentlemen, if you haven't noticed, the price of oil, as a la the price of gas, has been falling over the past several years. And so therefore, that's not a good time to be invested in oil and gas. That's a good time to lose a lot of money in oil and gas. So clearly, putting all of your money into one particular asset class is not a very good idea, or even putting a high percentage of your money into one particular asset class. And when I talk about asset classes, I'm talking about stocks, bonds, real estate, cryptocurrencies, metals. If you've got $10,000 and you put $9,000 of it into just one of those categories, you are making a serious error, in my opinion. You are risking a lot. Again, I've mentioned this many times, gentlemen. Spread it around. Put it in numerous different uncorrelated asset classes. In other words, as one thing goes up, hopefully one thing goes down. If stocks are up, bonds are down. If real estate's up, hopefully I've got something that's staying stable, if not going down. You get the idea. Spread it around, gentlemen. Number two, what else did they do wrong, in my opinion, relative to losing $2 billion? Specifically, they made a huge error, and this was mentioned numerous times in this article. Leverage. I've mentioned this numerous times. Leverage is a form of debt. That's it in simple terms. What they were attempting to do was magnify or amplify their investment returns, or what they hope would be positive investment returns, by using leverage. Just using a simple example, let's say they had $1 million and they were able to get 10-to-1 leverage on that $1 million. They had $1 million, they got 10-to-1 leverage on it, letting them control $10 million worth of, again, oil, gas, whatever they happen to be investing in, which is fantastic as long as the investment is increasing. So the leverage can be very, very positive if your investment is increasing. However, if it goes against you, gentlemen, you end up bankrupt. You end up losing a lot of money very, very quickly. Or at the very least, you will have what is called a margin call. In other words, what the extender of the leverage would be saying to you is, you must put up new monies immediately. And I'm not kidding when I say immediately, speaking from personal experience. You must put up money immediately to meet this margin call if you want to hold this position. Otherwise, we will automatically sell you out and you can deal with whatever huge loss you happen to have, which inevitably you'll have. Third thing that's not mentioned in this article that I think is critical. One of the killers, absolute undeniable things that will cost you, my friend, a lot of money is when you're overconfident in your investments, when you have hubris in your investments, when you're married to an investment, where you've got this fanatical devotion that this thing, it's going to go up. I can feel it. I can tell it. Everybody tells me so. I watch YouTube videos about it every day. Everything I read on the internet says it's going to be fantastic, etc. Gentlemen, this should be a huge warning sign to you. This is what's called confirmation bias. When you're only seeking out positive feedback relative to your investment, that is a huge danger sign, gentlemen. You must be willing, and I know this is very difficult. This is very difficult even for me. You must be open-minded that you could be wrong. You've got to start seeking out information that disconfirms, that is totally against your investment theory about a particular investment class. In other words, if I think stocks are going to go up, I need to start reading about what people are saying who think stocks are going to go down. If I think bonds are going to go down, I need to start reading articles about people who are saying bonds actually are going to go up. I know it seems counterintuitive, but gentlemen, it's not about the survival of the fittest. It's about those that can adapt, that survive. And to adapt, you've got to be open-minded and willing to listen to alternative points of view and change directions when necessary and admit when you're wrong. All right, that does it, gentlemen. Hit the subscribe button if you haven't already. Hit the like button if you enjoyed this. Of course, I want you to buy me a cup of coffee. As always, John Galt out.